Well, investors are clearly going to be on the lookout for earnings from Nvidia. The chip maker that has gotten the lion's share of the market attention this year is set to report results next week. That could provide some further clarity on all the AI demand that was consuming the market earlier this year. Nvidia shares have bounced off their lows, but certainly that theme, it's helped the likes of Microsoft and Meta and all these companies that are spending a lot on AI right now. But broadly speaking, we've started to see some cracks in the chip sector. The semiconductor index, the SOX that gets tracked very closely on Wall Street, has had a challenging time over the last month. Nick Mersch is an associate portfolio manager at Purpose Investments and joins us with a deeper dive into the technology sector. Nick, great to have you with us. What are you thinking about, first of all, on like a company like Nvidia? I would imagine there's going to be like 3 days of buildup, like a Taylor Swift concert or something like that next week. But what's your general sense on that company as it pertains to this whole AI spending boom right now?
Yeah, absolutely. And I think you kind of hit the nail on the head in terms of Jensen Huang kind of has a lineup similar to a Taylor Swift concert when it comes to sort of the hype around this stock. And I think if you look at the market right now, and if you want to pick one stock that is the market right now, Nvidia is the #1 most monetizable company in the hottest area of the market. And there's two really important things to watch for Nvidia. So the first is the revenue forecast going forward, because a lot of the implied valuation really does bake in the future growth expectations of this company. And I think what the market mostly missed here was an article that came out from The Information. And this article had indicated that the Blackwell series, which is NVIDIA's next set of chips, could be potentially delayed. And this article was published on the Friday night on the same weekend that the carry trade unwind happened. So I think it got a little bit lost in the market. So if this delay does make NVIDIA change their forecast, the entire market, I think, is going to really receive this negatively. However, we did get a lot of notes out that this delay is only 6 to 8 weeks instead of quarters, and the order book is incredibly strong. And that NVIDIA can really backstop any of the delays in this Blackwell series with their current run, the Hopper series. The second thing to watch for when it comes to NVIDIA is the margin profile. So while this stock price really has skyrocketed, I think even after this sort of recent sell-off, it's rallied about 25% over a 6-day period here. Each time they print earnings, they keep getting cheaper because they keep pushing the goalposts out in terms of just how much profit they print. So these are software margins at a hardware company, and we've seen this in this market before, and this company is Apple, and they've done pretty well. So what the margin profile really indicates is just how much pricing power NVIDIA has. So AMD announced a server-level acquisition either yesterday or the day before to really try to capture more of the stack, but they are far and away a very distant second, and NVIDIA is the one-stop shop for all AI components. But any erosion in the margin profile could mean that either competitors are taking share or that incumbents are finally getting good at building their own silicon, which we're starting to see signs of. Despite these areas of caution, for now anyway, NVIDIA is a dominant force in my opinion, and could be the first $5 trillion company if this CapEx cycle still has another 2 to 3 years of build out, which I do believe it has.
You know, I think that's the tricky part for investors. We had a longtime analyst, Dan Ives of Wedbush. I like the quote that he shared with us last week on NVIDIA, which is he's anticipating this to be another drop the mic moment when they report their results. So it's true. Maybe there are some delays with new products, and maybe the market won't like that, but maybe there's something we're not seeing right now in this AI revolution, which will kickstart fresh excitement. I was talking about the broader semiconductor stock performance, though, as I was introducing you. And if I look at where those stocks have come from their peak this year, they've bounced off the lows, but they're still down, call it double digits from the peak. And I know Nvidia is one company, there's a whole chip ecosystem, but it is an industry that typically is seen as being a cyclical one. We had a guest already this morning, David Burrows, who noted that a lot of these tech stocks have not gotten back to their previous highs, even though they bounced. So how would you describe general sentiment for this sector after all the gains we already saw this year?
Yeah, absolutely. And what I think you have to think about here is that the sector itself is not just one stock. So there's an entire value chain that really has a lot of depth behind it. But at the end of the day, look, we're in the midst of one of the greatest CapEx super cycles in recent memory. Demand for semiconductors, specifically on sort of the NVIDIA GPU side, far outstripping supply because we need so much compute power to really power this new technology. And if you go back to the earnings period, every major CEO came out on the call and really provided a lot of commentary that CapEx spending is only going going to increase from here. And I think the most notable, Razak and Sundar, that they came out and said that there's dramatically greater risk of underinvesting rather than overinvesting when it comes to competitive positioning. So a lot of this is really just not getting left behind. But think about this for a second, right? So these guys are printing hundreds of billions of dollars in free cash flow every year, so they have more than adequate resources to fund it. They can't spend money on M&A because they're going to get antitrust cases against them, like we're seeing with Google. So your capital allocation strategy is now essentially narrowed to three options for the most part: buy back stock, pay a dividend, or pay Nvidia for their GPUs. And they're going to continue to be a massive beneficiary of this. Another important thing that you saw on the commentary from the CEOs too is that this infrastructure build out is somewhat hedged by their existing operations. So a lot of these mega cap players are heavily invested into the data centers for the use case of AI, but they can also use a lot of this capacity to power their existing core businesses, whether that's making return on advertising spend more efficient for Meta, whether it's sort of boosting the Azure business within Microsoft. But this does bring a lot of point of contention, which is we need to see some R in the ROI when it comes to AI revenue. And quite frankly, we haven't seen too much of that yet. It's mostly a story for next year.
Okay, so this is the trick, Nick. This is the trick for investors right now. We're at this point in the market cycle. People are making a great case for broadening beyond technology, looking at other parts of the market. I guess at the end of the day, and I hear this from a lot of people at the end of the, I used to work in Silicon Valley and they've covered these technology companies. Over the last 20 years, this is the runaway hit. It's the big performing sector. So I guess there's the long-term risk of not being invested in game-changing companies if that's what you're looking for over the long term is the best performance. So what are you talking with your clients about right now when it comes to where you're invested, given you've got this big macro theme, but obviously investors have grown a little bit tired of tech's run up until this point?
Yeah, look, my message to them would be stay the course. I mean, cloud growth is strong. The three mega cap players, AWS, GCP, and Azure, refer to the hyperscalers. If we look at their number, they're growing at impressive growth rates from a massive base. In the early days, this was fueled again by this digital transformation, by bringing these workflow processes online, but it's now being accelerated by these AI workflows. In terms of kind of broadening out, we have seen a lot of these themes around the data center specifically in terms of just the power that's needed to be generated to power these things. Extremely power hungry facilities. So we're seeing a lot of the tertiary plays also attached to this, whether it's the cooling systems, whether it's the energy companies that are connecting to the grid, whether they're the data center REITs themselves. And a lot of these companies really can benefit from that. And I think the people that are kind of get really caught up in the run that tech's had in a year-to-date basis, a really unloved area of the market, if you think about technology, is software. Year-to-date, software has really been left for dead. Investors were really concerned that AI would kill software, but I think it's going to be a really critical distribution layer when you think about how AI is going to be consumed and how you think about it at the end product. If you look at a company like Salesforce, they're trading at 6 times EV to revenue, 15 times EV to EBITDA. These multiples have absolutely compressed from the 2020 highs, and I don't think you need a drastic re-rating in order to have an attractive risk-reward profile to rotate back into some of these names. So while you're looking at the whole tech space in general, I do think you have to split it into these different components and really maybe revisit these unloved areas like software.